Imagine you own stock in a booming tech company.
Right, a real cash cow.
Exactly. You check the quarterly earnings, the cash flow is just incredible.
Profit margins are widening.
Yeah, and you're feeling like a total genius for putting your money there.
You're planning your early retirement.
Right. But then imagine the CEO of that booming company legally forces it to commit financial suicide.
Just completely tanks it.
Yeah, and all just to pay off his family's private debts.
It sounds illegal, right?
It sounds insane. You wake up, check your portfolio, and a quarter of your wealth has just vanished overnight.
Poof, gone.
So today, we are looking at the exact math behind how billionaires legally steal your money in broad daylight.
We are dissecting this massive landmark study from the Journal of Finance. It's from 2002.
Okay, let's unpack this, because I am still in disbelief.
It's titled Tunneling or Value Added, Evidence from Mergers by Korean Business Groups.
Quite the mouthful.
It is. But the researchers, Ki-hong Bae, Jun-koo Kang, and Jin-mo Kim, they spent years gathering data to prove something really dark.
Something that will make every retail investor listening just sick to their stomach.
Absolutely. Because, usually when we talk about corporate mergers, you think about value creation.
Right. The financial press sells us this whole story. Two giants merge.
They build synergies.
1 + 1 = 3.
Exactly. You think they're building a better future for you, the investor.
But think again, especially in the world of massive conglomerates.
Yeah, an acquisition might just be this totally legal way to move money out of your pocket.
And straight into the billionaire founder's private vault.
We are looking at a 20-year span here, from 1981 to 1997.
Which is like the most glorious and dangerous period of the South Korean economy. The Han River miracle.
Yeah, the economy was booming, but hidden right beneath it is this invisible web.
A web designed to literally siphon wealth.
To understand this, we have to talk about the Chaebol.
Right, the Korean business group.
Think of a sprawling empire. You've got an electronics company, heavy shipbuilding, retail, hotels.
All separate companies on paper, publicly traded.
But all ultimately controlled by a single founding family.
But wait, let me play devil's advocate. Didn't these large business groups actually build the country?
They did. That's the traditional view.
Right, the value-added view.
Economists like Tarun Khanna argue that in developing countries, outside markets are weak.
Like, you can't just go to a local bank for a $1 billion loan.
Exactly. So the Chaebol acts as its own internal market. It funds its own best projects. It adds value.
Okay, that makes sense. But then you have this other view, the tunneling view.
Yeah, coined by Simon Johnson. This is where it gets dark.
Because when corporate governance is weak and ownership is super concentrated, those at the top get greedy.
They dig a secret tunnel.
They just suck resources out of the companies you invest in.
Straight into the companies they secretly control.
Wait, so if I buy shares in a booming firm, the CEO can just legally siphon that cash away?
Yes, entirely legally.
It's like I bought a ticket to a luxury cruise, but the captain is, like, siphoning the ship's fuel into his private yacht.
That is the perfect analogy. And these three financial detectives spent decades gathering the data to prove it.
They analyzed 107 mergers
By publicly listed non-financial firms on the Korean Stock Exchange between 81 and 97.
Why this specific time and place?
It was the perfect laboratory. Massive economic growth, but practically zero legal protection for minority shareholders.
So it's basically the Wild West.
The Wild West, but the sheriff actually works for the bank robbers.
I mean, if these 30 organizations sneeze, an entire country catches a cold.
You really have to grasp the Leviathan scale of the top 30 Chaebols.
Give me the raw data.
Okay, they make up only 24.2% of the listed companies.
Less than a quarter.
But they control a staggering 62.5% of total assets.
Wow.
And 72.6% of total sales.
Here's where it gets really interesting, though. How do they afford to be that big?
Debt. Extreme, mind-blowing debt.
Yeah, the top 30 Chaebols operated with an average debt ratio of 90.6%.
Compared to 75.4% for non-Chaebols.
90% debt. How do they even get away with that?
Cross-debt guarantees.
Right. They literally co-sign each other's massive loans.
They are gambling with the nation's money.
If one falls, the whole house of cards comes down.
Which leads to this completely counterintuitive nightmare.
The mergers.
Right. In a normal world, two giants merging makes the stock price soar.
But in this world, a merger announcement is the ultimate signal to run for your life.
Let's look at the actual stock market reactions.
Yeah, break down the numbers for us.
When independent, non-Chaebol firms announce a merger, their stock goes up.
Like it should.
Right. They see a highly significant positive return, plus 5.5%.
But when a top 30 cable announces a merger,
The stock just
the
drops.
market smells blood.
Exactly. Why the opposite reaction? Because the market instantly recognizes a robbery in progress.
They know the big boss is digging a tunnel.
The resources are being siphoned out.
But surely they can't just steal the money. It has to be legal, right?
It's the dark magic of legal theft.
Which is terrifying.
It's not outright fraud. They use dilutive share issues, forced mergers, moving assets at rigged prices.
Completely legal.
Yeah.
And completely devastating to the retail investor.
Let's look at a bloody case study from the text, the LG Group.
Oh man, this one is rough. When you buy stock in a highly profitable company, are you ready to pay the debts of its bankrupt brother?
That's exactly what happened. LG Securities was highly profitable,
A great investment.
but LG Merchant Bank was a complete disaster. They lost $400 billion, won in just 97 and 98.
$400 billion.
So what does the LG Group do? They forced the profitable LG Securities to buy the dying LG Merchant Bank.
And the market reaction.
LG Securities stock collapsed by 24.6% in just 10 days.
24%. Wiped out. Why on earth would they do this?
This is the aha moment in the data. Look at the controlling family's ownership.
Okay, let's see.
The family owned 18% of the profitable company,
Right.
but they owned a massive 60% of the bankrupt company.
Oh, I see where this is going.
Let's do the math. For every dollar overpaid in the merger, the family lost 18 cents.
Because of their stake in the buyer?
Right. But they gained 60 cents on the other side.
Because they own the seller.
Exactly. A net profit of 42 cents on every dollar destroyed.
A net profit for the billionaire and a brutal loss for you, the retail investor.
It's like you and your friends chip in for a pizza,
Right.
but the guy who owns the pizza shop is in your group,
Uh-huh.
and he votes to charge yourselves $1,000 for the pie.
Wow.
He loses his $20 for a slice, but he pockets the $1,000 for the shop.
That is sickening. He just openly robs his friends.
And the data doesn't scream, but if you look closely at these numbers, they are begging for help.
Let's talk about the specific findings, the silent scream of the data.
Yeah, let's look at the statistical tables in the paper.
Without getting bogged down in the academic jargon, obviously.
Right. In the brief window around a merger announcement, independent companies generated that 5.50% positive return.
People like the deals.
But the top 30 Chaebols? Negative 0.39%.
Basically flat or losing.
And on the exact day of the announcement, non-Chaebols went up 1.3%. Top 30 went down 0.05%.
So the minute the news hits, the market punishes the Chaebol.
What's fascinating here is that this isn't a fluke.
Or just a bad business cycle.
No, it is a systematic mathematical proof of wealth expropriation.
Which leads us to the structure. How do they actually pull this off without getting voted out by shareholders?
The invisible web of cross-shareholding.
You don't know it, but your retirement fund just became a stepping stone for a billionaire's son.
It's structural evil. The top 30 Chaebols average a 27.6% cross-holding rate.
Compared to just 16% for independent firms.
And they use this to pass down power. Look at the story of Samsung SDS.
Right, the tech services arm.
They issued bonds with warrants to the chairman's son.
Basically, a coupon to buy stock at a certain price.
Yes, and they priced it at a measly $7,151 per share.
Okay, what was the actual market price?
55,001.
Are you kidding me?
I am not.
They gave the boss's son an 87% discount.
And completely diluted the value of every other shareholder's stock in the process.
This web allows a single family to exercise dictatorial control over 60 companies.
Without actually owning the majority of the equity.
You, the minority shareholder, have zero voice.
And it gets worse. Let's talk about the original sin of profitability.
It's a performance trap.
Yeah.
This part is just totally counterintuitive.
Right. In the Chaebol universe, being too successful is the most dangerous thing your company can do.
It makes no sense. The better a firm performed before a merger, the harder its stock crashed after.
The numbers are stark. Highly profitable Chaebol bidders saw returns of negative 4.26%.
So good companies crash.
But poorly performing Chaebol bidders, they saw positive returns of 1.92%.
Why? Why would the market reward a bad company buying something?
Because if a company is flush with cash, the controlling family targets it.
It becomes the perfect donor
Exactly.
to bail out their failing side projects. It's a punishment for success. You build a massive reservoir of cash, and the boss immediately hooks up a massive hose to drain it.
It's a tragedy for good management.
Which brings us to the most blatant version of this, The rescue mergers.
Do you want to know exactly how your money disappears? Watch a rescue merger in action.
Define that for us.
A healthy group company is forced to buy another group company that has negative net income.
Or even negative book equity.
Meaning the company is technically worthless, it owes more than it owns.
And the data proves this is a disaster for you.
Rescue mergers by top 30 Chaebols result in a significant 3.04% drop in stock price.
Just a straight-up plummet.
And non-rescue mergers don't show this drop.
So it's specifically these forced bailouts destroying value.
It's a forced blood transfusion.
The wealth is reverse distributed, pumped out of the pockets of minority shareholders.
And injected directly into the veins of the failing enterprise.
All to save the controlling family's pride and their wealth.
It's a zero-sum game.
If your stock price is plummeting into the abyss, whose portfolio is rocketing to the moon.
We have to unpack the logic the researchers used here. They treat the entire business group as a single portfolio.
Okay, so they look at all the companies together.
Right. And they found that when the acquiring company stock drops, the stock of the other companies in the group actually goes up.
Wait, really?
Yes. The returns of the acquiring company are negatively correlated with the controlling shareholders' ownership.
But the rest of the group's portfolio goes up. So what does this all mean? It means the merger was never meant to help the acquiring company.
Never.
It was a sacrificial lamb, slaughtered to feed the rest of the billionaire's empire.
It's the final mask being pulled off. If we track the insider accounts, the truth is undeniable.
The company's value drops by millions, yet the boss buys a new yacht. Let's look at the boss's bank account.
The paper reveals the ultimate proof, the changes in the market value of insider holdings.
Give me the stunning numbers.
During the merger announcement, the inside family's wealth in the acquiring company dropped by an average of 105 million won.
Okay, so they took a hit there.
But wait, their wealth in the other group companies rose by 614 million won.
Oh my.
If we connect this to the bigger picture, the personal balance sheet of the Chaebol family nets a massive surplus.
It's a perfectly executed, mathematically proven wealth transfer.
But you have to ask, why didn't anyone stop this?
Yeah. Where were the watchdogs?
They were legally muzzled and blindfolded. It was a desert of governance.
There were no outside directors on the boards.
Zero transparency.
Institutional investors were legally restricted from using their voting rights.
And what about the banks? They owned up to 10% of these companies.
Right. Shouldn't the banks have stepped in?
The banks stayed silent because of those cross-debt guarantees we talked about.
Oh, right. If the bank speaks up, they trigger the guarantees.
And the whole house of cards collapses.
The bank would destroy itself by trying to fix the problem.
Exactly. So they all just look the other way.
Which brings up the craziest part to me. The Stockholm Syndrome of retail investors.
It's a real phenomenon.
You know they are going to exploit you. You know the game is rigged. So why do millions of people keep handing them money?
The paper provides a really chilling answer.
Lay it on me.
The too big to fail implicit guarantee.
Nah.
Investors know a Chaebol won't be allowed to go bankrupt.
Because it would just absolutely tank the national economy.
The government would have to step in.
It's the ultimate illusion. You buy in hoping your company will be the one getting the blood transfusion next time.
Instead of the one giving it.
It's a twisted lottery. You're betting on being the parasite, not the host.
It really is a cycle of history.
The names have changed, the countries have changed, but the secret tunnels are still being dug under your feet today.
Whenever legal protections are weak and ownership is heavily concentrated, mergers cease to be about creating value.
They become weapons of wealth transfer.
This raises an important question. Are we seeing this today?
With our modern global tech monopolies.
Exactly. When any corporate empire grows so large it dominates an economy, the temptation for tunneling exists.
Whether it's a traditional conglomerate in the 90s or a Silicon Valley megacorp today.
The mechanisms might look a little different.
Maybe it's not a cross-debt guarantee, maybe it's super voting shares.
But the outcome, the wealth transfer, that remains the same.
So take a hard look at your own investment portfolio. Look at those mega corporations that own dozens of other platforms, apps, and services.
When they announce a massive, multi-billion-dollar acquisition,
are they building a better future for you? Or are you just paying for the shovel they're using to dig their next secret tunnel?
it's something every investor needs to be awake to.
Thank you for joining us on this deep dive. Keep questioning the surface-level narratives of the financial world. We'll catch you next time.